Good afternoon, everyone, and again, welcome to the Capital Market Day of AAK. I will continue the description of AAK through a financial lens, if you will. And we will then have a Q&A, as Johan mentioned, after my session here. As we announced in October, we have generated a very strong performance in Q3 and for the full year of 2022 so far. And just to give you a hint, this is then despite, of course, great volatility, macroeconomic challenges, and also a very positive effect through a currency that we've seen. But if we clean our results out for that, it's still a very good performance. And as you can see, if we start looking at the third quarter, our volumes remain stable. They're down 4%, but when we exclude our exit from Russia, they're at -1%. This is then driven also by our optimization efforts in bakery, and we've also seen some reduction in volumes in terms of our technical products and feed business, primarily a little bit slower output on feed itself. But we've also used some of the biofuels that we generate for internal use, as utility prices have increased dramatically, as you've seen. And when we look at our adjusted operating profit per kilo, this is our margin measurement. At fixed rates, we're up 10% in the quarter. And that generated 822 million of EBIT during Q3, up 5% at fixed rates. When we look at the year so far, year to date, volumes are still stable, and even if you exclude Russia, we're up 1%. In a challenging market, I would say, and still performing when we talk about our optimization efforts, and a little bit less volumes in our TPF businesses, as I mentioned before. Our operating profit per kilo is up 7% at fixed rates to 125, and that generated an operating profit of 2.1 billion so far for the year. This also includes about 60 or 70 million of reduced EBIT due to our exit out of Russia. So that needs to be included on top of that to make a like-for-like picture. Our return on capital employed is at 14.8%, which is down slightly from 15.5% if you compare it to last year. Looking a little bit more at volumes, and this is a picture to describe a little bit what's happening below the surface. If you exclude Russia, the volumes are fairly stable, as I mentioned. But what we see is within our food ingredients, our optimization efforts, candle waxes are down to some extent, and this is from a high peak during the pandemic, so we're back to pre-pandemic levels in terms of candles. Chocolate and confectionery, we're actually up 11%, so very, very strong growth. This is then year to date, but that's also the number for Q3. And as I mentioned before, technical products and feed, a slight reduction, but we see positive trends going forward. And that leaves us with the 1% year over year. Another way to show our volume development is by region. And here you can actually see that the volume growth is driven mainly by Latin America and also by Asia. We also see a small contribution from North America. The one that sticks out is Europe. And of course, this is where we see our exit from Russia, of course, and also our optimization efforts in our bakery and dairy business. But that's part of the challenge going forward. When we look at the result, you see it in the same way. The volume decrease that we have experienced hasn't really impacted our earnings to any great extent. The big driver, the positive driver, is price and mix. And here we see our optimization efforts paying off. We're making choices in terms of what products we sell, what customers we engage in, to the extent that we can. to move up the value chain. Our special nutrition is also improving, which is really nice to see after a few years where we've had difficulties with the earnings, and we've seen some reduction, but this is now coming back. And this is also, of course, showing our ability to offset inflation, price increases, and I'll come back to that later on. But inflation in general has been going up for about a year. We've seen inflation in our raw materials for the past 2 years, and significant ones. And we've been able to offset these, as well as non-oil input to our production, utilities and logistics, still increasing our EBIT per kilo, our margin. And then you see the FX effect, which is, of course, a very nice addition translationally when we move it into SEK. Last year, we had a negative effect. This year, it's been significantly positive. But even with that, 7% up year over year. SG&A is increasing, and this comes from a pandemic level, I would say, where we now spend more money on customer interaction and product development. This is another picture showing the combination that generates our margin. You have volume in blue and EBIT in green. And for a long time, EBIT has been trailing volume in this type of graph where the indexes are the same on both sides. The two of them in combination gives our EBIT per kilo. We saw this up until Q3 of 2020 when we saw a shift. We actually surpassed 1 SEK per kilo. And that development has continued during 2022, as you can see, in a very nice way, with volumes being more stable than they have in the past. Driven by our exit out of Russia, we haven't seen any major M&A or acquisition in the last couple of years, and also the optimization efforts that I mentioned before. This is then broken down a little bit further, where we then look at volume growth and EBIT per kilo. How do we generate our EBIT? And if you look at the period as a whole, we can see that volume has been the lesser contributor with 4%. EBIT per kilo has grown about 7%. If you divide it up in two periods here, from 2015 to 2018, volume was the big driver. And then in the last couple of years, from 19 to 22, EBIT per kilo has actually grown 11%, volume has grown 1%. So there's been a bit of a shift here, still generating the 10% year-over-year increase of EBIT that we are committed to. I spoke before about inflation, and this is a graph that shows some of our raw materials. You can look at palm oil, for example. During the period between 2015 and 2020, we saw on average around $600 to $800 per metric ton. And then in the beginning of 2020, we saw a huge increase, almost tripling, up to $1,800. And this, of course, puts a lot of pressure on a company such as AAK. 80% of our cost base is raw materials. We then saw by mid-2022, the prices topping out and then reducing very, very quickly over about 6 weeks, down to about $1,000 per metric ton. This is, of course, challenging, the volatility in itself. But what it also means to us is that, of course, very important that we make sure that we don't absorb this cost increase. Our EBIT per kilo would collapse very quickly. And as you can see from our results, we've been able to do this very well. In addition to this, we also have, as I mentioned, utilities, logistic cost increases, and so forth that we've seen over the past year. One factor that's difficult to offset, and you've seen that in our cash flows, is the increase of our working capital. Because every time we introduce a new batch into our inventory to cover for something we've sold, it's at a higher price. And that then continues to increase our working capital, putting pressure on our net debt and cash flow. So when looking at this, before the price increases, we had a working capital of about 5 to 6 billion. That has doubled in the past 2 years to 12 billion. This year alone, we've seen an increase of 4.5 billion on our working capital. And I'll come back to how we manage that. what we do and what we can affect, the prices on raw materials are difficult, but we focus on the areas where we can do something to try to, at least to some extent, offset this. So we focus on our working capital days. And as you can see, we've worked very well with the DSOs and the DPOs. Focus going forward is the inventory days. But as you can see as well, we're back to the working capital days that we had before the pandemic in the low 70s. When it comes to investing activities, this includes CapEx and M&A. You can see the development here since 2015. We've averaged our CapEx around 800 million a year, just north of that. We had some difficulties last year due to delays in material for CapEx investments and some delays in engineering services that we bought externally. This year, we're back again, and we expect to have an investment of just north of 1 billion SEK. The money we invest goes to, as we've communicated before, safety, sustainable initiatives in our factories, capacity expansion, efficiency, and maintenance. And I would say sort of just less than half of it goes to maintenance, and the rest is new investments, if you will. And as I mentioned, the increasing raw material prices are putting pressure on us, and you see this in our cash flow. Despite the increased earnings in terms of the EBITDA, we do see a highly negative or highly increasing working capital, putting a negative effect on our cash flows. And this is the increase that I showed you before. 2-3 times, this is what we see. There is also a delay in this because, as you saw as well, the raw material prices have topped out and are now declining, coming down almost 50% since the summer. We have a 6 to 9 month delay in that effect into our working capital. So we still expect to see Q4 be highly impacted by the price increases that we're still experiencing 6 to 9 months back. And then in the beginning of 2023, we expect to see the decline and the relief in our working capital as well. But Q4, expect a continued negative effect. When we look at our capital employed, as I mentioned, we're at 14.8%, coming down slightly from 15.5%. And this is, again, despite an increased profitability, it's difficult to offset the large increases in our capital employed and working capital. We expect this to continue to drop slightly in Q4, given the lagging effect that I mentioned before. Same thing with net debt to EBITDA ratio. It's increased from a sort of an average level of 1.25 to 1.5. We're now slightly below 2, and this might increase slightly as well coming into Q4. But still at a healthy level, I would say, despite the huge volatility that we've seen. Our loans and duration profiles. In total, we have 12 billion of loans and finance debt. 83% is classified as long-term, 17% is short. We have unutilized funding of about 5 billion in here. So we still have a good platform for continued growth and continued volatility should that happen. And as you've seen through our press releases, we've also increased our debt over the last couple of quarters to meet this volatility and future growth. When it comes to our capital allocation principles, these remain the same, but the focus is on our core business investments. And here, of course, we talk about capacity and efficiency increases. We talk about expansion, either in existing assets or greenfield and potentially brownfields going forward, and also in our efforts within innovation. Mergers and acquisition, very high on the agenda, and you saw our release here last week on the acquisition of a new facility in India, which Dheeraj will speak more about. The first two bullets there, geographical expansion and capacity expansion, is what we call bolt-ons. Geographic expansion is when we go into a new area and establish ourselves. Capacity is more when, as we did now in India, when we buy something where we're already present. We also invest in technology and capabilities, and you've seen our investment in, for example, Greenon a few months ago, and also in adjacent product portfolios such as lecithin that we've bought 2 small entities in. So we try to expand around our core, not to deviate too much. And then there is a fifth one, of course, and that's the sort of game changer. Some of the larger acquisitions that we might be able to do in the future, consolidating the industry. Something we keep our eye on, but of course is very few and far between. When it comes to dividend, our policy still remains 30 to 50% of net profit to be dividend every year. And we have a growth of above 10% annually in our dividend historically. So to sum it up, AAK is delivering on a long-term promise. We have an operating profit that's grown more than 10% over the last couple of years, and you can even draw this out down to a 10-year stretch, and you see the same performance. Most of that is coming from the operating profit per kilo, adding about 7% of those 11. We also have our earnings per share and dividend per share up both 12% year over year. That's it from me. Thank you very much.
Thank you for that, Tomas. And while Johan is making his way up to Tomas, I really would like to update the password. It's Nobel 1901, Nobel 1901. Sorry for that. The first question is actually to you, Tomas. With this, I know that you talked about it before, but you can elaborate more on that as well. With this extreme volatility in the raw material market, how do you manage this, and what is the impact on AAK?
Well, as I mentioned, the impact is mainly on the working capital side, but the risk also lies in the P&L, of course. What we try to do, and we've done over time, even before the increases, is to, as much as possible, hedge our raw material purchases back to back with customer sales. So when we have a customer sale, we also make sure that on that day, we also commit the raw material needed for that product to that customer. So we avoid effects of prices going up and down during delivery period. It's not a perfect system, and it has its challenges, and particularly when you see the volatility that we've seen. But that's what we try to do to avoid speculating in the market, if you will, and show our true performance through our operations instead. And of course, that's also a challenge when prices goes down. Customers come back and contract management becomes vital. Us making sure that the contracts that we've entered with our customers, that they stick to them. And it's sort of a first in, first out of deliveries, so we don't get stuck with high valued inventory. And I think if you look at Q2 and Q3, we've been able to perform very well in that area as well. So volatility is there, but I think we've done a good job so far.
Thank you for describing that for us. I will actually start by asking the people here in the hall, if you have any questions, hand up. Yes. Thank you, Stina.
Thank you very much. Does it work? Yeah, okay, yeah. Perfect. Daniel Levin from Nordea Markets. And I have one question here, and that is on the standard for infant formula in China. And I read some news the last few days here that there will be a change to require milk powder to keep a higher percentage of fat, and that would go through from February 2023. So I just wonder, is this something that will impact you? Could you perhaps share a bit around how you think about if that's a potential or a risk perhaps for you?
Thank you. Well, maybe bring it into a bit of a longer time period. China is a big market for infant formula. Some of you know this, that you use infant formula a lot from a culture perspective, and parents also pay a lot, meaning that there is a premiumization trend, even from, call it, the consumer or parent perspective. But there is also a high focus on this in China. This is an example. So there has been talks about, and there has been over time, and asking, how do you really make it better, etc. Right? So I think this is a step on that journey. In essence, I don't see it as a risk for AK. It's an opportunity because the trend is towards better products. And that's an opportunity for AK. Some legislation, some impact, of course, in general terms, can be negative in a short period of time or so. But I think the overarching positive here is that you put focus on high-quality product. And that's where we typically deliver well, and already today in that market.
So,
anything to add there, Thomas?
No. No. Good answer.
happy with that answer? Yeah, we have another one over there. Yes, please.
Hi, good afternoon. My name is Oscar Lindström from Danske Bank. Thomas, you mentioned M&A and consolidating the industry. Do you have any sort of blank spots, which either in terms of geographic footprint or market presence, that you are thinking of in particular? And is market share an important factor for you? Thank you.
Well, when you look at M&A, I think there are opportunities in all regions we're in, even in Europe, where we're fairly well established. So we are very active. We have a very solid pipeline that we continue to follow and work with. But I would say that the majority of the acquisitions that we've done in the past, and I would say from a size perspective, that would be the sort of majority going forward as well, unless you look at some of the game changers, will be these bolt-on acquisitions. And those are focused on geographical coverage or capacity. So I think to your question, yes, we do see great opportunities in all regions where we are, and we follow a pipeline in each region. And I think that the opportunities are there. But it's a very stochastic process, of course, right? And it's not something where you can see an even result every year. And you've seen that if you've followed us as well, right? It goes a bit up and down.
The market is not that fragmented, so there is not refineries standing in every corner of the world waiting to be acquired, right? So that's why we work systematically, region by region, country by country, to evaluate the opportunities that we see. So opportunities are there, but we need to be patient in order to make them happen.
And also make sure we do the right acquisitions. So that's a very important key, that it fits AAK, the way the company looks today.
If I may follow up, with regard to your mentioning sort of game changers, without mentioning any companies or specifics, what kind of directions are you seeing that would be game changers for you to move into when you say something like that?
Well, I think what we're referring to here, are we able to convert something that is bigger than a bolt-on in one plant in a country, right? That is a bit more game-changing. And when we come to that, we can just look at the facts in the industry. There is not that many, and I'm not going to comment it further than that. But we are interested in being able to continue consolidation to make AK stronger and to deliver stronger value. And the other piece of, call it game-changing, could be if we decide to go a bit more aggressive, bolder, bigger on an adjacency, where we've said today our strategy is about the core, the oils and fats expertise, but expanding it to adjacent portfolios, which makes a lot of sense to the core. There are opportunities to go maybe a bit bolder and more aggressive there, but that has to come, and we're not going to take too much risk in such an adventure, but that could be game-changing at some point in time.
Very interesting. Thank you.
Thank you. Yes, please.
Yeah, so Kenneth Toll from Carnegie. Two questions. I'll take them all at once. The first, you mentioned down trading. So as a risk, have you seen your customers choosing simpler solutions yet?
Well, maybe a slight correction. I'm not sure I mentioned down trading as a risk, but maybe as a behavior and a consequence of the current climate. So speaking of down trading conceptually, one down trading is a consumer buying a product, right? So you go to the store and you're going to go home with a product of a kind. You might choose a lower cost brand, or you might go to a lower cost type retail store, right? You still come home with the product, right? That's a bit of down trading as a consumer. You can, as a producer, of course, say that I need this ingredient. I used to buy the highest quality with the best spec, etc. But I'm prepared to go with a slightly lower quality, lower spec, cheaper. That's also down trading in a business context. When you look at that from an AAK perspective, yeah, we're a high value-added solution provider. So is there a risk in that? Yes, but at the same time, in some of the industry where we serve, our product is actually a product that helps our customer to reduce their cost of goods, their bill of material. So you can, in essence, say that when they may be downtrained from, cocoa butter is a good example. If you want to buy our cocoa butter equivalent, it's cheaper than cocoa butter. If you look at that as down trading, that's an opportunity for AAK. So I think that's a bit of the beauty with our business model, many legs to stand on, that there are shifts in patterns, but we can actually say with regards to down trading, it is opportunity and a bit of risk. And we have a portfolio that is wide enough to be able to serve also the down traded option. So we're not necessarily concerned. I was more articulating what is happening. And I know that many investors have been asking about down trading. So I think that's where we stand today.
Great, thanks. The second question is on inventories. You mentioned your own inventories, but also when prices of raw materials goes up and down a lot, there could be big swings in inventories, either in the whole supply chains, I mean, before you and your customers and so on. And maybe it has to do with harvests, if harvests are good or bad. So can you describe a little bit how you see the inventory in the whole supply chain right now? Is it crowded with inventories, or is it running very low? Or
we don't see, as you see, and I will present a bit more during the strategy session, that we serve many different industries, right? Meaning many different customers, many different applications, and end consumer products. So there's a wide spread. So there's not kind of one answer for everything. But if you take an average of where we operate, you don't see a big issue with huge stock and destocking risk or vice versa, low stock levels, and now we have to fill up. We have, since COVID, been on a quite continuous basis, back in business again, and it wasn't that impacted compared to other industries where you saw a dramatic increase of volume and then maybe a shift to the other side and vice versa. So in general, I wouldn't say that there is a major impact of that, but I concur with your comment that in fluctuating times, in volatile times, of course, there is a bit of that because everyone tries to operate their company the best way. So you might be a bit careful and then you hold back, or you might say that I accelerate a bit more because there is a scarcity of products. And we have had a bit of that where we sourced early when the war came and got stuck with a little bit. And in other cases, it's been the opposite, right? So, of course, it's a bit fluctuating, but not dramatically. I don't know if you have...
No, but we have seen in certain segments, like candles, for example, after the pandemic, we saw a little bit of destocking, but what we've seen has been temporary. We also saw in the beginning of 21, when prices were on the rise, that some customers pulled back a bit on the length of the contracts that they wanted to go into, thinking that prices might come down. That's one of the views, at least, that we took on it. And I think when they saw prices continue up, they came back very quickly because they needed to cover the volume. So it's more those type of behaviors, I think, that we've seen rather than a big trend towards destocking or changes in inventory levels.
So much more dynamic dialogues with customers, for sure. Yeah. But again, the underlying demand, the pull by consumers are still there.
Yeah. Thank you.
Thank you. Yes, please.
Good afternoon. It's Alex Sloan from Barclays. A question just on chocolate and confectionery fats. You guys have really grown very well there over the last couple of years, well ahead of the underlying market. I wonder if you could help us maybe break out how much of that has been you guys winning new business and new customers versus maybe referring slightly to the last question, any inventory build at the customer level there that's helped growth. I guess this was an area back in 08-09 where there was some destocking. So just thinking about CC&F, how you're thinking about destocking risks into 23 would be helpful.
Do you want to go first?
Yeah. I would say I concur with your view that we've had a very good development within our chocolate and confectionery fats. The way we see it, we take market share today, and driven by our sort of approach with co-development, co-creation, functional solutions to our customers, that would be the primary driver as I see it. We haven't seen any other big trends in terms of as you mentioned, inventory levels and so forth. It's us taking market share. That's our conclusion on it.
And I think another thing to add to that is, now, again, forward-looking, anything can happen. But if you have looked over the last few years, one important ingredient in the chocolate market as a whole is, of course, cocoa and cocoa butter. And cocoa butter has been quite stable, or even declining a bit. So you can say that the cost of chocolate to produce chocolate hasn't increased as much as some of the other ingredients, even though utilities has gone up and a few other items has gone up. One important thing in that sector hasn't gone up that much, meaning that I would assume that our customers have been able to produce to a fairly okay price still, and with that, the actual price increase needed in retail hasn't been that dramatic as it could have been, and that is, of course, helping. So in essence, you could argue that is chocolate now, compared to other things you could eat, somewhat less impacted, and I guess part of the answer is yes. And then you have the element of comfort food, you can and premiumization and indulgence. I'll come back to that. There are a few things impacting the chocolate industry where you have a bit of competing trends, right? You want to maybe downtrade the way you buy it, but at the same time it's a bit of comfort food. But there is, of course, the element of if it get really tough, then of course you can always skip chocolate. So everything is there, it's valid. There is a risk that will go down, but at the same time, we've seen a very strong trend even through COVID and this last year, which has been very dynamic.
And I think the strength of our business, you've seen the volumes go up in the last couple of quarters, and as Johan mentioned, over the past 2 years, you've seen almost a decline in cocoa butter prices and a steep incline in prices that goes into our product, and we still see the volume coming, right? Back to our solutions, functionality that we provide, not only a competitive product from a cost point of view, but also from functionality into chocolate.
Thank you for that. Just discussing with the gentleman here. We're a little bit over time, but I promised him the microphone, so here comes the last question before the strategy update. Right. Yes, please.
Thank you, Karin, Handelsbanken. Quick question on inflation and the costs, sort of the non-oil costs, energy and logistics. Yeah. How do you feel about your outlook for the coming 6 to 12 months?
I think when you look back in the previous year, you've seen tremendous increases, and we have been able to manage that, both utility-wise, non-oil input, secondary input into our production, as well as logistic. As you might remember from our last Capital Markets Day, we did outline the split of these costs. So 80% relates to raw materials. You see 2% on utility, 5% on logistics, and about 7% on other input. So keeping that in mind, raw material is the biggest one. But so far, we've been able to deal with it, but we are, of course, very cognizant about continuous increases and always look to see how we can make our operations more efficient. Some of the capex that is related to energy efficiency, of course, is much better business cases today than they were in the past. So we always look to make it better and more efficient. And there are risks with this going forward. There's no question about that. But I think the good thing in our business, as we see it, is that raw materials has always been a basis for discussion with the customer, and they understand that if the price goes up 3 times, our product will go up price-wise as well. So I think that just the fact that there is that structure on raw materials, I think makes it a little bit easier to discuss also other increases with the customer, and that's what we've been successful with. But the risk is there, and we keep a very close eye on it, of course.
Final comments, Johan?
No, I very well laid out, and I think no doubt there is massive increases for us and others. Shipping is one of them, utilities, and those are cost items that, of course, we get a significant share of. But as you said, there is that dialogue, and we of course keep a tight eye on this in our contract management, in our build-up of costs, so that we try to be really early in understanding what is coming our way and how can we deal with it, and be having a transparent and professional dialogue with our industry and customers.
Yes.
Yeah, that's how we approach.
Yeah, thank you very much for that. Thomas, thank you for now.
Thank you.
You are coming back definitely for other Q&As. Time for strategy update, and we will have a specific Q&A after that as well.